And we have three different strategies and different managers, as Chema said. All of them probably complementary and are very successful in their different niches. But to make sure that we have after this introduction a proper debate and we understand how and why each one answers in different manners, I think it's worth to a bit understand of how you define your different strategies. So we have a value manager. If we needed to put tax, which is probably something that I don't really like as much, but we definitely have a long short equity manager, a value manager, and a growth manager, all of them from the US.
So just to give you a little bit of history on our team, we have all worked together since 2002, 2003. Same team, same philosophy, same process. Our predecessor firm was called Mazama Capital. We focused on growth equity, starting with small cap growth and moving up eventually to large cap growth. In 2010, we formed a relationship with EFG to market the all cap or the large cap product, which is available today. And in 2016, we made the formal jump over to EFG. So we have a bit of a longer tenured relationship than say Bryan. But our focus in terms of style is we're trying to identify companies that are taking share with superior products or services. Each member of the team has a specific industry focus. So I'm specifically focused on healthcare. We have team members that are focused on technology, financials, industrials. And we believe it's that deep industry knowledge going to, for myself, the American Society of Clinical Oncology and talking to physicians, talking to the scientists that are actually doing the research, trying to identify what are the novel trends in cancer, whether it's immunotherapy, cell therapies, and the like, and then bringing back that information, vetting it out with the team through consensus portfolio management and making investment decisions. So by traditional metrics, price to book, let's say, our companies may seem to be, our portfolio companies may seem to be expensive, but they're also companies that are executing well, driving market share, and are poised to really dominate those markets over the long term.
Yeah, so we are value managers. We started in 1983, and we invest with a price discipline. So we're targeting companies with low price to earnings or low price to book ratios. And we invest in quality companies. So these are the types of companies that generate strong free cash flows, that have strong balance sheets, and that are oftentimes leaders in their industries. These types of companies are managed well. They perform well in different cycles. And we look for strong allocators of capital and that have proven themselves over time. And we've been successful with the value discipline. And we look at companies typically that are trading on the bottom 20 percentile, whether that's by price to earnings or price to book. But at the end of the day, we're looking for good businesses that are undervalued with quality management teams. And we're finding a lot of opportunities there today. So we're excited to be part of the new capital team with the Cullen Large Cap Value Fund. And we do have a mix of mid caps and as well as large caps. And we typically hold about 40 companies, so we are concentrated.
I started Bluemar about 10 years ago. We are a long short fund. What that means is that we bet on some companies to go up and we bet on other companies to go down. The return stream that Bluemar generates is a return stream that is mostly generated by alpha, which is the differential between longs and shorts. The beta of the fund is about a third of the market beta. So the majority of the returns is through alpha. Our philosophy is very simple. That alpha return is a lot higher quality than any beta return because it's taken without market risk. In terms of our style, what we do, what we look at, we invest across both growth and value. I think for us, the key to outperforming as a fund is really two things. Number one is to find a niche industry or set of companies or themes that you understand very well and where you think you have an edge in investing and you can see how things develop. And secondly is the ability to be tactical. So, being tactical means taking advantage of dislocations that occur in the market. It means taking advantage of dislocations that happen when there's growth to value rotations, when markets go down, sometimes when they go up on the short side. things like that, misunderstandings, and really by combining both of those things, the deep fundamental research on the core positions with a tactical bend, is really the formula, in our opinion, to outperform.
With this debate, it's always value against growth. And even in our investment committees, we don't really have very clear what is value and growth, because it seems like value or growth, it's different things for different people.
So first, we think of growth companies as companies that have idiosyncratic growth opportunities, regardless of the economy or what the market does. Typically is when value works. It's because the majority of the value of a company has to do with the cash flows of the immediate years. And this is why, value tends to outperform when rates are higher and the economy is getting better. However, our view is that really the value outperformance tends to be tactical. It lasts for 3-6 months.
I don't necessarily think it is. I think investors recognize that the value of a company is really a function of earnings as well as interest rates. So what the current company can earn in the future, as well as interest rates. And I think a good example for us would be a company like Microsoft. And in one of our portfolios, we bought Microsoft stock about 10 years ago. It was trading at 12 times. And Microsoft is a terrific company. They have great cloud software. They're leaders and they're taking share. Free cash flow is growing 20%, and they have great margins. And what's interesting, over this 10-year period, Microsoft's been a stock that's been owned by many growth managers as well as many value managers.
At this point in time in the cycle, most of those attractive growth names are capable of growing in any market cycle, whereas the value names tend to be tied to macroeconomic concerns or health. And as we have the adoption of these vaccines on the horizon, those growth rates are going to accelerate. So that's where we are in our portfolios. We've had a number of pandemic winners, take your pick, whether it's Align Technologies or Teladoc, and we're trying to gradually shift the portfolio to where we see growth. And where we are starting to see signs of growth is in the value universe. Integral part of our process. We look at quality. We look at whether or not expectations from an investor perspective are reasonable. We are also looking at half of our process is strictly quantitative. Is the company trading at a reasonable PE to growth ratio? And then the last criteria is based on ROE. So we're trying to identify those attractive asset-light models that will eventually drive tremendous free cash flow over time. It's always unusual when value investors and growth investors collide. I recall.
So with value, if one believes that an effective vaccine and therapeutics will put an end to COVID, then I think we'll see this rotation trade and the reopening of the economy. But I don't think value stops there. Is that coming out of the pandemic, a lot of cyclical stocks may surprise to the upside, because what they did during the pandemic was cut a lot of costs out of their operating structure. And we've seen this in other cycles. Some inflation is welcome for value investors. A steeper yield curve, some higher rates, a weaker dollar, those play well into some traditional value sectors. For example, like financials.
I think there's a couple elements to that. Number one, are the vaccines efficacious? Between the Pfizer vaccine and the Moderna vaccine, they have both shown fairly consistent efficacy. I think the technology is there. The RNA technology, the speed to market is impressive. The safety data that I've seen thus far for both Moderna and Pfizer has been fairly clean. And we're talking about studying this vaccine in 30 to 40,000 patients. The two things that I'm concerned about are, number one, we still don't have data as to how durable these vaccines are. Do people, will they take that second dose? Will they come back and take a dose a year later? That remains a question. And then the second pushback that I would say is that, it appears that we should have adequate supply in the near term to cover the high risk populations.
And specifically with regards to banks, you said it well, US banks are quite different than European banks. However, in both cases, they are very regulated entities. Okay, as you can see from the ECB ban on dividends in Europe, as you can see from the Fed ban on dividends in the US, as you can see from the CCAR stress test, from the capital rules, from everything. Number two, they are highly dependent on the economy and specifically on the level of rates. And number three, they're of course, being disintermediated in many ways in their highest earning fee streams, like payments and things like that, through by fintechs and by challenger banks. And so it's really not a great place to be from a secular perspective at all. We focus very much on what we call GARP, which is growth at a reasonable price. Right now, you can buy some regional bank like FRC, JP Morgan's at 14 times next year's earnings almost. It's at 12 times 2-year forward earnings. And this includes, by the way, the credit recovery that everybody already knows is happening. So it's not a surprise to anybody. And however, companies like Fiserv, like FIS, which are secular growth companies that are taking advantage of digitalization of payments, that have very recurring revenue streams, are trading at 20 times next year's earnings. And of course, if you compound those numbers 3, 4, 5, 6 years out, then these companies are trading cheaper than the banks. And so from our perspective, we understand the value bounce, but we participated in it, by the way. We did have a bit of tactical overweight in that sector or in those sectors for the last couple of months. But I do believe that the majority of it is probably at this point over.
If you take the value sectors and look back historically, there's always been some sort of disruption. And now we're seeing some digital disruption. And there certainly will be some winners and some losers. And that brings me back to my earlier point of really investing in strong companies with good management teams. And we pay attention a lot to quality and their decision-making to transform themselves as well. When we look at management teams, we try to be very thoughtful in terms of how they're taking their cash flow and reinvesting it, and how they're going to participate in the recovery that we see coming once travel comes back and industrials start to recover globally.
We're always looking for to identify disruptive companies, disruptive technologies where the expectations are reasonable and we can drive surprises to the upside. I think everyone that has talked here today has talked about we focus on quality. Number one, we have a strict and consistent process. That's what you want from asset managers. And you only make money when you're able to drive a change or have the company deliver above expectations, or if you're short, the opposite.
I think one opportunity to focus in on that, be pretty reflective of how we've been spending our time this year after the pandemic in the springtime.
The first thing I'll say is Bluemar, the objective of Bluemar is to generate 9 to 10% a year compounded over time, irrespective of markets, okay? There will obviously be better years and worse years, but mostly we've only had one down year in the last 10. And we really focus about 70 to 75% of our return is based on alpha. So it's a very high quality return stream. Why Bluemar today? The simple answer is because there's an enormous amount of uncertainty and dislocations that we see. We think that there are very big secular changes occurring. There are very big consumer behavior changes occurring, and there are very big factor rotations that are occurring. All of these things make it so that the amount of tactical opportunities is as high as we've ever seen.
Y nada más, o sea, muy agradecidos a todos los asistentes. Esperemos que os haya gustado.
Gracias.
Gracias.
Thank you.
Thank you.
Thank you very much. Bye.
Thank you.
Yeah.
Bye-bye.